Bonds are sold as a safe place for your money. However, since 2020, many investors have discovered that bonds can in fact go down in value. So what gives? First, let's take a moment to explain the basics of bonds. When you buy a bond, you're lending money to a government or a company. In return, they promise to pay you back the borrowed amount, known as the principal, at a future date called the maturity date. Meanwhile, you get regular interest payments, known as the coupon, for letting them use your money. Traditionally, bonds have been considered safer than stocks because they are a steady, predictable investment. You know exactly how much money you'll get and when. Even if the borrower runs into trouble, bondholders are usually paid back before stockholders. Stocks, on the other hand, can go up and down a lot, and you might not get your money back if the company doesn't do well. Bonds are a more stable, reliable way to grow your money. However, this description of how bonds work does not match with reality for most investors. That's because it's more common for people to own a bond fund rather than an individual bond. The way that bond funds work differs from individual bonds, and this often confuses people. Bond funds own a basket of different bonds, for example, government bonds from different countries or bonds of different maturity lengths. When you invest in a bond fund, you're essentially buying shares of that basket. This setup gives you instant diversification, spreading the risk. You can easily buy or sell your shares in the fund, making it a flexible and convenient way to invest in bonds without having to pick and manage individual ones. Bond funds often have lower investment minimums, making them more accessible to a broader range of investors. This allows individuals with smaller amounts of money to participate in the bond market. As we discussed, the return on investment (ROI) from an individual bond is predictable. When you own an individual bond, on top of the semi-annual coupon payment, you should get back 100% of your money at the maturity date. However, the ROI from bond funds is less straightforward. Why is this? The coupon payment that you get when you own bonds is determined by prevailing interest rates. For many years, interest rates in developed countries have been low, as you probably noticed when checking how little the bank pays you on your savings. However, since the pandemic, we've seen interest rates rise as governments try to fight inflation. When interest rates go up, investors holding bonds still get their coupon payment along with 100% of their original investment. However, if a bondholder needs to sell their bond before the agreed date, they will get back less than they paid for it. This is because the rise in interest rates has made newly issued bonds pay a higher coupon. Your bond pays a lower amount, so it needs to sell for a lower price to make up for that. Let's look at an example of how an investor called Bob could lose money on bonds when interest rates rise. Bob buys a 10-year bond with a value of $10,000 and a 5% coupon rate. This means that Bob will receive a fixed amount of $500 each year for 10 years and then get back the original $10,000. A year after Bob buys the bond, interest rates rise to 6%. This means that new bonds are now offering a higher yield than Bob's bond. the price of Bob's bond falls because investors can now buy new bonds with a higher yield, so they're less willing to pay as much for Bob's bond. As a result, the price of Bob's bond falls to $9,000. If Bob sells the bond before maturity, he'll lose $1,000 because he'll have to sell the bond for less than he paid for it. The example above shows how it would be possible to lose money on bonds when interest rates rise. However, it's important to remember that Bob would only lose money if he sold his bond before the maturity date. If he held until the agreed time, he would not lose any money. Now, let's go back to bond funds. Bond funds are marked to market. Marked to market means that the current value of a bond fund is calculated daily based on the current market value of the underlying bonds in the fund. This means that the price of a bond fund can fluctuate up or down on a daily basis, even if the bonds in the fund have not yet matured. In other words, it shows you how much you would gain or lose if you sold your bond fund today. It's important to note that over the long term, rising interest rates are actually good for bond fund holders. And that's because most bond funds reinvest their income payments in new bonds. As interest rates rise, the funds will be able to purchase new bonds with higher yields, which will boost their overall returns. In conclusion, both individual bonds and bond funds can appear to lose value when interest rates rise. However, investors will only lose money if they choose to sell their bonds before they mature, or in the case of bond funds, before the average maturity date of the bonds in the fund. In this sense, bond funds are no more risky than individual bonds. In fact, their diversification makes them less risky. Over the long term, the income from your bond fund should outweigh the losses from declining bond prices. However, it's important to remember that bond prices can be volatile in the short term, especially during periods of rising interest rates.